Well, as always, it is a pleasure to be here. And now that my voice is actually, now that my voice is actually doing better, I'm really excited to have a club discussion and to be back teaching a topic or going through a topic anyway. So, for this topic, we are going to jump over to the CRE financially modeling exercises. I'm going to copy the link, and for the video, I'm going to give you a view-only link, but after the video, I'm going to make this interesting. Since the spreadsheet is not fully enabled, oh, apparently I just gave you an editing link. Since the spreadsheet is not fully enabled yet, I'm going to open it up to let anybody who wants to edit, and we'll see what happens. Maybe we can come up with a great 1-page or 2-page spreadsheet that will allow people to analyze single family or small multifamily properties here. And I'll walk through this and show people exactly how it works. So, does anybody have, I know that there's a lot of news going on right now. The real estate market has been very difficult this year. Last year, there was almost an 80% drop in transaction volume within multifamily. And then this year, it's been increasing expenses and increasing inflation that's really been making it difficult, as well as increasing interest rates. So does anybody have any specific questions around economy before we get started? And then we'll dive into the Fourplex or discussion topics. All right.
So one question,
Yeah.
Daniel. Um, do you recommend investing in rental properties at this time, even though the cash flows are not positive? Uh, because no, I'm not sure whether we need to wait or whether we should start investing. Two
Right.
reasons, right? One is the interest rates, if they are going down in future, that's okay because we can refinance. But the challenge is right now, there are like now some rumors about a recession, and then like no the job market, and there is a possibility that no suddenly no people are getting laid off, and then the prices are slashed down right now, like no 30%, 40%. So my concern is like no 5% decrease and all that. I'm not concerned too much, but if it goes down by like no 30%, that is where. So, what do you suggest? Is it a good time to start investing, or it is better to just sit and wait?
Well, a couple of thoughts there. The first thought is it definitely is getting more and more difficult in order to find good deals out there. The cash flow is very thin at the moment. Having said that, there are always deals that can be found. Um, so in any type of market, there's always the possibility of finding a good deal. It just may take more legwork, and you might have to be more particular about it. In terms of properties dropping 50% or so, I don't think that's going to happen for a couple of reasons. One reason is that 40% of single family homes in the United States have no mortgage; they're owned outright, and the low interest rates that we've had over the last couple of months have given another large portion of the population mortgages with very low interest rates. When you've got a very low interest rate like that, you are going to hold on to it because as the interest rates go up, your very low interest rate mortgage is more valuable. And so you will find out, instead of selling your home, you will rent it out, you will renovate it, you'll figure out a way to hold on to that low mortgage because you're paying, such a low premium on the capital that you've borrowed. So a large portion of the US population is not in a position where they are going to be forced to sell or be distressed sellers. Having said that, there are always distressed sellers in the market, and currently the number of them are increasing. So I do think we're going to continue to see distress. We're going to continue to see headlines around that. Um, and barring a black swan event of some sort, I don't see prices decreasing that much. Although depending on your locale, like the West Coast, for instance, we have seen a pullback in prices, a fairly significant pullback in prices. So I do think that that will happen around the U.S. And that's part of the reason why it's harder to find good cash flowing projects. Excuse me, I'm not 100% well. um, I think it's a good time to be very, very particular about the project that you're getting into. I haven't invested in a new project in almost a year. Of the 14 projects that I've done, we've had 6 give good returns, and we had one that just closed that unfortunately did not do very well for our investors. And so it can be hit and miss, and it can depend on how much attention and how much time you're willing to put into it. So that's my tale. I don't see a catastrophic event. I think we're going to continue to see asset price inflation, unfortunately. Although we now have more downside pressures coming from the economy. So in the short term, like I've been saying since 2021, I think it's time for a flight to quality, or it was then. And now we're kind of in the middle of that turbulent period. I expect that, by 2025, if you can survive till 2025, we're going to continue to see real estate be a good investment. But, there are always good investments and bad investments in any economic environment. So that's my 2 cents.
Thank you, Dan.
Anybody else have any thoughts? I mean, that's a topic I bet everybody has some thoughts about.
I have a follow-on question to that, I guess. Is there any previous like content or videos or anything that you have on like good methods for finding distressed properties? I know that's kind of the secret sauce to success here.
Right. So, one recent video you can go back and look at is Donato's video, which if I go back up here to the Speakers Hall of Fame, he's right here. He actually owns a data company called, what was it called? Bright Investor, I think is what it was called. Bright Investor. And he actually gives you some great topics, but we're going to go through and do a little bit of analysis here, and maybe enough analysis to get you started with our Fourplex. So
Okay.
I will give you some pointers, and hopefully, just interrupt me at any time, and we can talk more about, if you want to go into crime stats, or if you want to find out, what the median house appreciation has been over the last 10 years. We can deviate this. It's more of a discussion rather than a presentation. But do check out Donato Callahan's, and his name is now spelled properly as of yesterday. Okay, so the reason why this.
Can I ask a
Yes.
quick question?
Yeah.
Do you have any analysis in terms of ADU conversion? Because just like you said, the economy is
I'm sorry, I didn't catch that.
ADU conversion, pros and cons
Oh.
to watch out. Because I'm actually planning to do a conversion for a detached garage on one of my property because you don't have enough money to invest in a new property. You might just want to create one.
Yeah.
So,
I mean, I think it's a great strategy personally.
okay.
It's like any business or any investment. The whole key to it is creating value. And we have a neighbor. So ADU is a adjunct dwelling unit, I believe is what it stands for. It's basically when you create, a small 1-bedroom or 2-bedroom with a kitchen and a bathroom that is detached from your house. So some people call it the grandparents unit. But it can be put on Airbnb too and rented out as a short-term rental. So it's basically a secondary property that you locate on your current land. We have a neighbor over here that did it, and they have a wonderful little unit. Their father, I believe, is living in it currently. And it's a great way to drive value on your current property. The only thing, obviously, when you're doing it, you need to get in touch with whoever your local municipality is. You have to really understand what the regulations are before you start it, because you don't want there to be any surprises or gotchas when you've already started on the project. So you want to
Yeah.
make sure you understand the entire process. Even visit a city planner. Most city planners, you can make appointments at their offices or talk to people over the phone. So do your research before you start it, but I think it's a great way to boost the value of your property.
Okay. All right. Sounds good. Thank you.
All right.
Sorry, another question.
Yeah.
How about the interest rate? Do you think it will go down this year, like at least the second half of the year, or wait till next year?
So I'm not going to be able to find this off the top of my head, but there is out there a futures index. So interest rate futures chart, or interest rate probability tracker. That, yeah, I think this is it. Yes, this is it. So this is an interesting tool to look around with. I'll drop the tool here in the chat. And for those who are direct messaging me for the Speakers Hall of Fame, here it is again.
Hey, Daniel, can I make a comment about that interest rate question?
Yeah, go ahead.
So I have a strong opinion on the interest rate. So you always hear the Fed talking about, oh, is it going to be 2? Is it going to be 3? Is it 4 or 5? And when is it going to be? Is it going to be early? Is it going to be late? Are we in for a soft landing? So when it comes to real estate, I think it's important to realize that when the interest rates get reduced, it's going to increase the number of people who are in the market looking for a property, looking for a deal, looking for an investment. When there's more people looking, there's more demand, and it's going to drive up the price of the supply. So it's going to drive up the price of houses, and you might start getting into some overbidding or whatever. So I always tell people that you want to make sure you get a good deal right now, because interest rates might be high, and that's okay, because when they do come down, you can always refinance. But the one thing that you can't change is the price that you get into that house for. And I think that's a lot more important. You might get into it now and wait a little bit, so the interest rates do come down. But if you wait till interest rates come down, you're going to ultimately be paying more for that asset. So that's why I don't even think about the interest rates when I think about buying a property. I mean, I do think about it, but it's not something that's going to stop me, because I'm in Santa Clara, so I know that it's going to be a bidding war eventually. More of a bidding war. That's it.
Yeah, that's absolutely right. Lower interest rates means higher asset prices, and you can always refinance if they go down in the future, but what you can't do is go back and change that purchase price. Right on, Anita. So this tool here is the Fed Watch tool, and I need to read a little bit about the methodology that's used here, but from what I understand, they allow the general public to basically go in and give their opinion on where interest rates will be at the different Fed meeting dates. So you can look here, and there's going to be another Fed meeting in 12 days. And most of the people think that we're going to keep it exactly where it is. And then as you go further on in the future, we've got some people that think that it's going to come down. We've got some more people that think it's going to go down further. And you can see the distribution is beginning to spread towards the low end. So the majority of people out there think that it's going to go lower. I am not convinced of this personally. I think that there's enough economic. I mean, the Fed has always got a balancing act. They have to measure employment against the interest rate. Obviously, the more the interest rate goes up, the more expensive it becomes to borrow money. The money that is being put into that borrowing could have been used to, increase your inventory or hire new people. So there's always an inverse relationship in between the interest rates and the job employment. There's also the balancing act that the higher the interest rates go, the more the costs go up for everything across the board. Right now, I mean, over the past 4 years, we've seen food prices go up 40%. And a lot of that has to work its way through the economy. And there are other areas too. Housing has gone up, obviously, and then pulled back in some areas. But there are effects that need to work their way through the economy. And the Fed has to balance, lowering that interest rate and allowing the economy to expand quicker versus how much damage is that going to do. So I'm not convinced we're at a stable enough point where the Fed is going to significantly move it down. However, it seems to be that a lot of people do think that that's going to happen. So this is an interesting tool to look at. And like Anita said, if interest rates go down, prices go up. So, and competition goes up. So that's something to keep in mind.
Yeah, but if you're planning to sell, then probably look for a interest rate going down.
Yeah, absolutely. If your buyer can borrow the money easier, that makes it easier for you to sell.
And even the prices would also go up, I think, the property prices.
Real estate linked to the tool. I wonder, do people that join later not see the chat? I'm gonna have to figure out if there's a way to let them go back to the chat.
You can't see history when you join, Daniel.
Yeah. Okay. So let's dive in here. This particular idea for a talk came about because I had somebody email me earlier in the week asking if I had any advice about a fourplex. And I said, not really. However, it'd be a great discussion topic. So I would love to hear your thoughts on this as well. We're going to go to Mesa, Arizona. Now, Mesa, Arizona is not where I live. It's not an area that I know particularly well. And I know a lot of you people know it a lot better than I do. So I would love to hear your input on this particular area. But what I did is I just went into Zillow. I looked for multifamily, and I set a for sale link here. And then I basically went through and found the small multifamilies in here and found a fourplex. And they vary quite a bit. There was this fourplex over here that was 1.8 million. There's a fourplex over here that is 749,000. We're actually going to evaluate this one right here. I did a little bit of a pre-evaluation on each of them, and this one just came up with more interesting information. So we'll start here. First of all, I would love somebody to describe to me what is Mesa, Arizona like? Somebody who lives there, somebody or near there. How would you describe the area? Is it does it have good employment? What's the crime like in the area? Is there, I assume the walkability is probably not great. But what other thoughts does somebody have about Mesa, Arizona? Somebody speak up and give a description. Anybody from Arizona here?
Hi, I'm Sabi here. I'm from
Yeah.
Arizona.
Great.
I live in Chandler. Mesa is very close by.
Yep.
And according to me, Mesa is a big city, so I don't know where exactly you are, like at which location you are talking about. But in general, Mesa is a very nice city. I do own a condo there, so I know it's a nice city there.
Okay. Is all of it nice, or is there like a nice area and an area that's
There
not
are
as
nice
nice?
areas. For example, I own a
Okay.
property in Dobson Village. Dobson Village is a nice area, but I can't say that like all of Mesa is pretty nice. But job growth is pretty high there in Mesa. There are few companies investing now. So yeah, in general, yes, it's a nice place. Not as nice as Chandler, but it's pretty good, I would say.
Okay, great.
Okay,
Well-
so I couldn't help it. Off Broadway is a little hoodish.
Off Broadway is a little hoodish. Okay.
Yes.
So we've got a property on
put it in
Broadway
nice
that's
areas.
half the price of the other property. Maybe
Yes.
maybe that's why.
Yeah, if you're on the south side of the 60, then you're probably doing really good. Or if you go further, what is that?
Okay.
Further east.
See, where's
you're
the
good.
60 here? Okay, south side of the 60 down here. There's the 60. So I
Yeah.
can see that
There's
doesn't
that
look
little
like
area.
there's huge price differences between here. That's interesting. Okay. So looking at this one, the first thing that I always do when I want to look at a property is just gather basic information about it. So here's the address. Let's take the address. I'll throw it into a Google map and just do a quick scan of the area, see what it looks like around the property. Here's the property. There it is right there. It looks like there's, a low walkability score would be the first comment that I'd make here. But it looks like it's amongst a lot of other houses that might be nice, might not be nice. It's a little hard to tell here, but there's nothing that's really strange, like something that stands out here, like a undesirable building that's next to it. It looks like a pretty normal area, just at a cursory glance. So that's that. The second thing that I usually like to do is I'll go over to either a place like Best Places or city-data.com and just learn a little bit about this particular zip code. So I believe it was, what was it here? It was 85204. So we'll stick that in here, 85204. Let's try that again, 85204. All right, that's interesting. That wasn't my experience 2 days ago when I went through this. All right, Mesa, Arizona. All right. See if I could do it up here, 85204. Okay, great. We've got the 85204 zip code here. One of the first things I do is I look at cost of living. This is probably similar to most of the areas within Arizona. It's slightly higher than the average US average, although not extremely higher. It's not in California ranges. Climate, I think everybody knows what the climate of Arizona is like. It's hot. Your utilities are going to be highest in the summer months. Very low precipitation. That's why there's gravel everywhere. Jobs are interesting. So, hey, best paying jobs are in science, worst paying jobs are in personal care. There's good paying jobs in utilities. It's had a decent job growth over the past year. That's a very respectable number, 3.3%. Normally that's a number that you really have to do your research on in order to get a good average on. I like to see job growth of at least 20 to 30% over a 10-year period. That's kind of a minimum for an area to invest in. All right, so nothing too off-putting here. Salaries are in a middle range. Actually, it would be interesting to see what an average salary is in this area. It's got an unemployment of 6.1%. All right, and you can see income by percentage of population. So we've got a lot of people that are in the 75 and 100 to 150 range, some up a little higher, which is pretty normal. Then I go to crime. City-data is a great place to get crime. Crime's a little higher than the US average. So this would be my first, especially property crime is a little bit higher. This would be one of my first yellow flags on the area. This might mean nothing, or it might mean that you've got a bad location. If with the crime being this high, and Anita's warning that it might be a little hoodish, I would probably want to go see the property, be hands-on there, get a feel for the area, obviously, before investing in it. But this is a little high, and it's something to look at and be concerned about. We can go to places like, I think it's Judgment Map or judicialmap.org. that will give us a heat map of crime over the area if you want to dive into this more. But we don't necessarily need to do that. High percentage of married people. It's actually interesting to see the population by age. So population is in the 25 to 34 to 54%. So we've got our working class population here. Retirement class people aren't necessarily here. It doesn't look like it's not a college town. So we've got a working population that are here, and you can continue to go through and look at other stats around this area. This one is actually fairly interesting here because we are looking at a fourplex, right? And so
it actually is a college town.
Hello?
So the north. So I'm in.
There, I'm gonna mute you, DJ. Thank you. All right. So let's start entering some of that information in over here. And we're going to go to the Proforma input tab. And I threw this together 2 days ago. Not all of the values over here are actually connected up on the spreadsheet, since you've all got editing access. If you would like to, implement a loan refinance equation into this, it's completely unimplemented right now. That's for the user or the developer to do if they would like to do that. So the property name I just put in Fourplex. The price, looking over here, $279,000. The physical vacancy, I just threw a number in there. It's a complete guesstimate. When you're going through and doing your initial analysis, a lot of times you'll just put in reasonable estimates. And then once you can get a ballpark figure of whether it's a property that you might be interested in or not, then it's your responsibility to go and verify your numbers. So what's the year that it was built in? This actually should be a regular number format here. So number format. All right. So looking here, it was built in 1937. It's been 59 days on Zillow, so that's fairly normal. Here's one thing that I found that was kind of strange. Zillow apparently will list the total number of bedrooms in a place, but then it lists the bathrooms, I believe, on a per unit basis. So you get a 8-1 here, but when you dig into it, it's actually 2 bedrooms in each of the 4 units, and then 1 bathroom in each of the 4 units. Either that or this is a typo. So I looked down a little bit further here. This is interesting. Pricing history. So the previous owner bought this in 2020 for $430,000. They're looking to sell it for $479,000. So that's a pretty good price increase there if they can get it. The monthly payment calculator, we'll come back to that. All right, walkability score, not particularly great. Elementary schools. I have never found elementary schools, necessarily to have terribly high scores. And even ones that do have really low scores, I often find that people like them quite a bit and or have higher opinions of them that I tend to see on great schools. All right. So next thing I'm going to do is I'm going to go over to the Treasury Department. So I clicked on Treasury, Maricopa County Gov, and I'm going to go look up this guy's property tax information. So I found his, actually, where did I get that from? Right over here. Okay, yeah. Parcel search. I found his parcel number. And when you search for it, you can find out that the assessed tax value per year is $1,169. They currently have $584 due. So that might just be that taxes haven't come due yet in that area, or maybe it's that they're behind in taxes. One thing I did note over here is that we actually got a mailing address here for the owner of the property. And so this is interesting. We can go look this up. First thing we can do is look up this name here. Let's see. And it looks like this is a realtor's name. So we've got a realtor here. And then the other name that I saw on it, where'd it go? So this name, I'm just throwing it in and doing a Google search. All right, here's Here's a LinkedIn hit. All right, so let me go back and look at that address one more time. So his address is in Denver, Colorado. And we don't know that this is necessarily the guy who owns the building, but he's located in Denver, Colorado. You can do more personal, reconnaissance on him if you want before buying. Find out maybe some of his motivation for why he's selling, or is he a long distance, renter? And if he's living in Denver, apparently he is a long distance landlord. So it might be interesting to ask some property managers in the area what the price of property management is and how they work with long distance investors. Or if you're in the area, maybe you can count on that not being part of the expenses that you're going to need to pay. So that's interesting here. I threw in a amortization calculator. So if you put 20% down on that price, you're going to be taking out about a $600,000 loan over 30 years, and current interest rates are around 7%. And so you can see your payment on a monthly basis, if we go over here, is going to be around $3,900. And we can go over to the calculator also and kind of look at that. In the calculator, I created an area here that lets you put in what types of units you have. So I named this a two bedroom, 1 bath. There are 4 of them. If you go look around Zillow, you'll find out that the market rent, or if you look on Best Places, is around $1,500. I'm sure people here could tell me differently, and there's certainly properties that are higher and lower. Not all of these items on the side necessarily apply to a fourplex. Some of these apply more to a larger multifamily. But you can always take those values and you can make them 0 when you're applying it to a smaller property. So acquisition fee. An acquisition fee is the fee that the investor would take on purchase of the property. If you are the investor, you're probably not paying yourself an acquisition fee. Transfer tax. Transfer tax, you'd have to look that up in your local treasury department to find out if there is a property transfer tax. I actually don't know if there is for Mesa. Does anybody happen to know if there's a transfer tax for Mesa? Okay. Closing costs. You can always pretty safely estimate the closing costs are going to be between 3 and 5% on a property like this. And are we doing a loan assumption? No, we're doing a new loan. I'm just putting in 80% of the value is what we're going to borrow, or a loan to value cost. So that means that 20% we are going to put down. And that actually is calculated out over here. So these numbers are important for the amount that you're going to pay in mortgage per year. Going down here, if you're going to do any sort of rehabbing, you can put how many months it'll take for you to do the rehabbing and what cost you think it'll be per unit in order to do that. The number of units that there are, and going in vacancy rate. This is the number of people that are renting the units when you buy the property. So 3 out of the 4 are currently rented if there's a 25% vacancy rate. And so when you're doing an analysis like this, you always want to start off by finding what the income is and what the highest level of income possible to achieve is. And this is called your gross potential rent. And in this particular case, I just added up, I did a multiplication of 4 times the market value to come up with this number here, and a multiplication of 4 times the Proforma value to come up with the stabilized number. So if we move this up to 1600, stabilized over here will change, and at purchase price, this is what your number is here, or rather, this is what the number reflects in the last 12 months on the property. So this number right here, you can go and investigate by contacting the broker. You can say, hey, let me know what the rents have been over the last year, and you can put that number in here. Vacancy loss. This is calculated just by taking the vacancy rate. You can put in whatever you think is a reasonable number here and subtract that up here. Obviously, with a fourplex, you're not going to have a 5% vacancy rate. But if you have it over many years, over that time period, and it's mostly full most of the time, and maybe there's a month or two where people are transitioning in between. 5% vacancy could be a reasonable estimate. It's honestly pretty aggressive when you're putting into a underwriting sheet like this. A lot of places have 8 or 9% vacancy, and that's fairly normal. So we add up all of our income sources. RUBS is utility billing back systems. So what this is I don't know, in different areas, it's customary for the landlords to either pay the utilities or not to pay it. Sometimes the tenants will pay the utilities. Sometimes the landlord will pay the utilities. If the landlord is paying the utilities, it could be bundled into the rent. Or there could be what's called a RUBS charge, which is an extra charge that's added on top of the rent to cover the utility cost. So the landlord might charge, $50 a month for electricity, or whatever it happens to be, or $50 a month for water, or $100 a month for water, whatever that happens to be, and that's counted as income towards your calculation in the property. And then of course it's also counted as an expense down here when you pay it. Loss to lease. The loss to lease is take your 2-bedroom, 1-bath, whatever the maximum amount of rent you can get in your market is, and then take whatever you're renting it out for, and that difference is called the loss to lease. So this number up here doesn't necessarily reflect what the numbers were on this particular property. This reflects the highest amount of rent you can get in this particular area, and then you subtract any amount that you are lower than that on the property. So let's say an average 2-bedroom, 1-bath in Maricopa gets $1,600 a month. If you're charging $1,500 a month for yours, you've got a $100 loss to lease. Vacancy loss, I think that's self-evident. You set the number down there. Concessions, this is like, hey, when you move in this month, you get half a month free. Or we'll give you 1 month free, half on the first month, half on the last month. Whatever your concessions happen to be, that's subtracted from your overall maximum potential. And then bad debt, this is anything the tenant just doesn't pay. Bad debt is usually anything not paid and is 90 days or older. So anything that hasn't been paid and it should have been paid 3 months ago or more. All right. And then down here, operating expenses, we'll start calculating these up. Contract services, I threw in ballparks here. I think that it's, you have to go and research these in order to come up with what's reasonable for where you are. But contract services might be camera security services. It might be landscaping services, might be pest control services. Anything that you are going to contract out for and pay someone in order to come and take care of the property. Repair and maintenance, this is usually pretty high. It'd probably be better, rather than me throwing a number directly in the spreadsheet, to put this as an assumption over here on the side somewhere. But I just threw in 5%, and that's a pretty low maintenance amount for a building that was built in 1973. Turnover cost, this is the amount of money that you are going to spend when a tenant moves out and you need to fix it up for the next one. So this is an annual cost. Utilities, whatever this happens to be, keep in mind this might be that this might be that the tenant is paying for electricity, water, and gas, and maybe you're just paying the garbage bill. And so maybe that's lower than you would think all the utilities would be. Administrative, this is going to be whatever your CPA charges in order to do the taxes on it, or whatever software you use to track this particular property. Marketing, that's self-evident. Insurance is a big part of the reason why cash flows have gone down recently. Insurance rates in the last 3 years have gone up by double and triple in certain areas. Triple in Florida, double in Texas, and in a lot of other areas around the country, 50% or more. So make sure you know what your insurance quote is in this area. And I did a quick look online to see what insurance rates are around here. This was approximately reasonable, but obviously it's going to depend a lot on what sort of coverage you want. Property management fee. So the property management's over here. I arbitrarily decided on 8% for your property management fee. It usually ranges from 7 to 10%, depending on the group that's caring for it. Or if you're doing it by yourself, you might put that at a zero. So add up all of your franchise taxes. There are only certain states that have franchise taxes. Alabama, Georgia, New York. I think California has them. But it's only about 10 states that have franchise taxes. And then replacement reserves, it's always good to allocate money to replacement. This is just how much money are you going to put aside per unit in case something breaks or for a rainy day. You know, and you might consider putting aside $100 or $200 per unit, or $100 per unit per month, something like that, just so you have it on hand when the dishwasher goes out or something like that. All right, so we add up all the income and all the expenses, and we can calculate an expense ratio. This expense ratio is actually fairly low. For a property that's 1973, I would expect this to be 40% maybe, but it can vary quite a bit depending on these numbers. Net operating income. This is just, if you look at it, the income minus the expenses. So this is the net operating income that you're left over with. Net operating income is always calculated before you pay your mortgage. So when you're looking at syndications and they're enthusiastically reporting their net operating income, keep in mind what they're not showing you is what their debt payment is. And I've seen groups do that. Incoming cap rate. This is just the amount of income that you're getting divided by the price that you paid for it. So how much return are you getting? What is your capitalization rate? Down here with the mortgage payment, I did a quick mortgage payment calculation where we took into account 20% down, or we're borrowing 80%. It's a 30-year loan, so 360 months, 7% interest rate. And this is your mortgage per year is going to be $47,000 approximately per unit, about $12,000. And after that, we can calculate what's your cash flow after your debt service. So per year, this property is making $3,200 or $800 a unit with these assumptions. Cash flow monthly total might be $270. And like I said, I do think expenses are going to be higher than this, so I think this will be lower. And then the calculation that Don was looking for. Oh, I see there's a lot of. This is why there's usually somebody else monitoring the chat while the person talks. I see there are a lot of questions here. I'm almost done, so you can take yourself off mute in a moment and ask questions. Break-even cash flow. So this is just the amount of money that the property needs to generate in order for you to pay your, if I look at it here, your expenses and your mortgage. So you need to generate $65K roughly in order to make nothing but maintain the property. And if you convert that into an occupancy rate, this property needs to be approximately 87.6% occupied on average in order to break even. So is it a great investment? Not really. Not really. With the person being out of state, and I do understand that prices have risen quite a bit during the 4 years that he's owned it. But I would probably try to hit him with a slightly lower price and see if he accepts it. That would improve this number a fair amount. All right, questions. And I'm just going to let you take yourself off mute and ask them. We've got 7 minutes.
Daniel, hi, thanks for everything. We had trouble getting in, like I guess several people have an issue with Zoom. Is there a way for you to go back and put in the links in the channel that you used earlier?
Oh, yeah. Yeah, absolutely.
I would appreciate that. Thank you.
All right. Anybody else?
I was going to ask about the cash on cash return. I think I see a question in the chat as well regarding that.
Right. So the cash on cash return will probably be the next thing we build out. In order to calculate a cash on cash return, there's a time component to it. So what you need to do is actually come over to a time series where you show the cash that you're receiving each month and then each year, and calculate that out, and then do a summation across it in order to calculate your cash on cash. One thing that's a little deceptive about cash on cash is that when you first buy the property, it's probably not cash flowing very well. That's why the person sold it. But if you improve the property later on in its life, it's going to be cash flowing better. So there's going to be a distribution between, at the beginning, maybe it's cash flowing 2% per year. And when you've got it all fixed up and rented out nicely, maybe it's cash flowing 8% or 10%. So when you summarize it all into one number, keep in mind that that's an average number across the entire time span. And if you want to look at the spreadsheet, I actually do have right here how you would calculate a cash on cash out for a property over a multi-year period. It's just not built out for the Fourplex yet.
Yeah, thank you.
All right, anybody else? I hope that was helpful.
No, thanks for including the cash and cash return, because that determines on how much money I want to put down. If I want to put down 20 or 30 or 40%. So
Sure.
that's what, that's what I want to check.
Yep. Yeah, and once you do a one-page sheet talking, so a pro forma, the purpose of a pro forma is to look at what the property is currently performing at versus what you think you can make it perform at. So it's how much do you think you can improve it? And that usually comes in pretty much right here. What the current rent is, what you think you can push it to, what the current expenses are, what you think you can get them to. When you are going to do a more detailed analysis, this is supposed to be a one-page sheet to give you a ballpark idea of whether it's a good investment or not. The next thing you should really do, and we will do this at a future meeting, is build out the monthly cash flow and do over time projection of what you think it will be. And then create a summary page. So I've got 3 tabs for that, 3 upcoming tasks. And this spreadsheet is open for anybody. I gave you all editing permission, I believe. So if you want to go in here and implement the loan refinance or connect up some of these other items that aren't connected, we'll do an experiment and see how it goes. I can always roll it back if somebody accidentally deletes it.
Where would we be able to access the sheet if we wanted to?
The what?
The spreadsheet that you're looking at. You said you gave us all access, but where?
The link is in the chat. Oh, actually, look here. Now here's the editor view.
Oh, okay. I see. Thank you.
All right. I'll continue to take questions, but I'll let you know next week we have Amanda Hahn returning. She originally came in April of 2020 and talked to us about the CARE Act. So she gave us updates on tax legislation that had been going into effect due to the pandemic. She's an active and a really good tax CPA, and she'll be joining us next week to talk about taxes. But I'll stay on here if there are other questions about this Fourplex. And then wish me luck. I have an interview at Intel today at 4 p.m. All right.
That's awesome.
All the best. Good luck.
Congratulations. Good luck.
All the best.
Luck.
Yeah,
Yeah.
good luck back to Intel.
Good luck, Daniel.
It's actually a position. So I originally got into computer science because when I was pretty young, actually, I was probably 13. I went down to the local library and I started reading up on AI. And I read through Marvin Minsky's papers, and our library didn't really have all that much, a lot of Lisp manuals. But that actually is what got me into computer science. And then over the last 20 years, I hardly have been able to do anything in AI because it wasn't a popular topic and computers weren't powerful enough to really work on it at home. And then, of course, recently it's just exploded. And so I'm trying out for an AI programming development position.
Good luck, Daniel.
You got this.
Good job, Daniel.
All right. Any other questions about the property?
Another question maybe from an engineer perspective. Like we see all these tech stocks performing easily over like next 10 years. I see them at least giving an annual return rate of 10% or so. So do you consider that to compare it with the real estate cash on cash return? It has to at least be 10% or more for you to invest in?
Well, I mean, numbers always give a picture into what the performance is, and there's always nuance that can be built around it, and it usually depends on what your goals are. So one of the reasons why I went into real estate more because like a typical engineer, I guess I wanted to control it more. And I also wanted to kind of stop checking my stock portfolio, 2 or 3 times a day, which I'd gotten into the habit of doing at one point. And so for me, I think the stock market, you should have money in the stock market, obviously. It's a great place to invest. It is directly competitive to the real estate market. Real estate is always going to move slower. It's always going to be less volatile. And it's always going to be something that you can directly affect. So you can go and repair your own property and add value to your own investment. And that was what I was looking for and why I liked investing in real estate more than stocks. And then, of course, since you have, in my mind, investment is about risk assessment. So when you look at what are my risks in investing in something and which of my risks can I control, real estate gives you an area to invest in where you actually can control more of your risks than you can in a stock market. That is probably the main reason why I'm more attracted to it. But to each his own. Everybody has their own risk tolerances.
Yeah, makes sense. Thank you.
Hey, Daniel, sorry to ask you this again, but where's the link for the recordings for the meetings?
Yeah. So the links for the recordings from the meetings are all at Alternate Investing Club. I'm going to start putting this in my regular email because I get this question a lot. But just go to alternativeinvestingclub.com and then click on Speaker Hall of Fame. I know the mobile interface right now kind of stinks. I'm going to improve that.
Got it.
In fact, I don't even think the link shows up on the top in the mobile interface. You got to go to the desktop version.
Got it. And this meeting will be under who, like for this particular one?
Yeah, it'll be here. Here was last week's. So Elizabeth Davis was our guest for last week, and it'll be right here.
Oh, sorry, I meant like for this, since it's not a speaker, it's just for the group. Yeah, you post it, so y'all see it. I'm sure I'll see it. Yeah.
Sometimes it takes me a few weeks to get the episodes up there, but I try to keep on top of it.
Yeah. Thank you.
All right. I'll let you guys all go. Have a wonderful day.
Thank you, Daniel. Good luck.